Good morning, everybody. Thanks for joining me today. Hope you all had a great Thanksgiving. A few of us and the Ardeni family got on JetBlue and we went off to St. Martin. We like that island. It's the weather's usually good. Occasionally it rains, but we had three good days and one rainy day. What we really like about the island is the French food. We stay on the French side, and it's you really can't beat it. Maybe you can beat it in France, but it's awfully good. So we took a few days off to St. Martin, and then we came home in time for Thanksgiving. Had three of my five kids join us. One of them, Sarah, went to Cornell's Culinary Institute. Well, she went to the hotel school, and then she went to the Culinary Institute. So she made us a Thanksgiving dinner, and it was awfully good. Never had deep fried turkey before. It was pretty moist. So, and it's, I was kind of concerned about it because you see all these videos of people throwing a turkey into one of these deep fryers full of hot oil, and the whole thing kind of blows up in their face. But Sarah knew what she was doing, so it all went well. You may be wondering where Max is. Max isn't joining us today. Usually he does. But when my wife is home, she gets his full attention. So my wife has a office in the house as well, and that's where he is. So Max is there, Bailey's there, Oscar. Oscar's visiting us. I know some of you liked seeing Oscar last time. Oscar's owner is my mother-in-law, and she's off to a trip in India. So a lot of family members doing some interesting things here. Hope your Thanksgiving went well and that you're doing lots of interesting things and have a lot of interesting family members. But let's talk about something that's of interest to us professionally, and that's what's going on in the markets. I think I figured it out. I think what's going on here is that we got a bull market that's started back on October 12th of 2022. We've been in that camp since late October, thinking that we're in a new bull market. Got tested from July 31st until, what was that? I think it was October 27th. Yeah, October 27th. We had something like a 10% correction, so garden variety correction. And then since then, we're up about 10% in almost a straight up move. And as I've shown you recently, if you connect the high of the all-time high of the S&P 500 back on January 3rd, 2022, connect that with the July 31st high this year, guess where we're at? We're exactly facing that kind of resistance, which is going to be interesting. I mean, if we rise above that, we could blast above that and set the stage for moving to new record highs, if not this year, then the next year. If something untoward happens and suddenly everybody turns bearish again, then we'll still be sort of in that wedge formation that I've been pointing out. I have to actually thank Jeffrey Dunlap for pointing out the uptrend that we have since the market bottomed in March 23rd of 2020. If you connect that bottom with the low on October 27th of last year, that line is exactly where we bounced off of in this latest rebound from the correction we had before. So hopefully I'm not confusing you, but you should be impressed by my ability to remember all these dates. So where are we now? Well, what's gotten everybody excited here in the market again? All of a sudden, I'm hearing people talking about targets of 5,000 for the S&P 500. We've been at 5,400 for over a year now, and so that's looking more reasonable. For a while there, it looked far-fetched, if not delusional. But I think what's kind of convinced people that the world's not going to come to an end after all, at least not for now, and that the economy may dodge a recession yet again, is I think there's a growing recognition that we can actually have inflation moderate without having a recession in the United States. I think one of the reasons for that is because China's having the recession for us. I would say that China's going into almost a depression kind of environment. At least they're going to something that looks like the great financial crisis that we experienced back in 2007, 8, 9, 10. And that is they had a huge property bubble, bigger probably than anybody ever had, bigger than Japan, bigger than the United States. And that property bubble has burst. And there's an article in Bloomberg, I think, today that the Chinese are scrambling to avoid a meltdown of their shadow banking system. But they certainly are trying to do what they can to avoid a meltdown of their mortgage lending system. Home prices have come down as a result of the bursting of the property bubble, and everything's sort of interrelated there. The provincial governments sold land to developers and used those funds to fund infrastructure spending. And the developers built those ghost cities that were largely viewed as investments by consumers, by households. Now the problem is a huge negative wealth effect. Those apartments aren't worth what they thought they were worth. There's not much liquidity in trading these things. And then meanwhile, the stock market, the China MSCI is actually down by over 50% over the past couple of years. So again, it's pretty nasty over there. And it's so bad that President Xi decided to come over to the APEC meeting in San Francisco last week on Wednesday and gave a very dovish speech. I think it indicated that he, his government, and the Chinese economy are in trouble. It was really dovish. It was very, let's be friends, let's cooperate, let's be partners in making the world a better place. He even talked about sending some of the pandas back to the United States because he knows we missed the pandas that recently were returned to China. So it was somewhat a bizarre speech, unless you recognize that it really reflected the weak position that he's in now because of the problem he's having with our economy. The bad news for China is great news for us. It probably significantly decreases the likelihood that China will invade Taiwan anytime soon. Doesn't take that off the table, but I think with China's economy in such trouble, they don't need to have more troubles by invading Taiwan and creating all sorts of havoc in the global economy and worsening relationships rather quickly with the United States and the West generally. The other good news is that China's bad news for their economy is creating some deflationary pressures. And for all the talk about the end of globalization and all that, the reality is we still, and the rest of the world still imports a lot from China. And so if their prices are going down, that's helping to bring inflation down rather significantly, again, without a recession. So the concept of immaculate disinflation, I think it's something I like to invent phrases. I don't think I invented that one, but I've certainly been using it. Maybe I did. Who knows? So anyways, immaculate disinflation is something we're enjoying here. We're seeing that inflation is actually coming down without having a recession. There's just a widespread view that the only way you can bring inflation down is by having a recession. Well, if they're going to do it for us in China, that's a pretty good deal. And so I think the market is kind of rejoicing, having a bull move here on the notion that we can have inflation come down without having a recession. Of course, the whole attitude of the market changed, interestingly, right on November 1st. Powell gave a speech at his press conference on November 1st, following the FOMC meeting, was interpreted as being less hawkish, not dovish, but less hawkish. Certainly, the market started to discount the likelihood that the Fed was done raising interest rates, even though Fed officials have continued to say, well, if they have to do more, they'll do more. But then again, they may not have to do more. And that's my view, and I think that's the market view at this point. Maybe the debate turns to how many rate cuts we'll get next year, but maybe just 2, not 4, maybe not much at all if the economy continues to perform reasonably well. Bloomberg had an interesting article, which we'll be reviewing, about something like 40% of Americans with homes don't have a mortgage. A lot of them are older baby boomers. They don't have mortgages. They are retiring. They had up a lot of retirement assets. They're getting lots of interest income, especially now, dividend income as well. And so you put that all together, you've got a lot of Americans who are actually doing remarkably well. I know you wouldn't know that by looking at some of the consumer confidence measures, but the reality is consumers have been telling the surveys that they're depressed, but acting as though they're not. Or maybe it's the old story that I've been telling for a while. Americans spend money when they're happy, and when they're depressed, they spend even more money. And apparently, Black Friday spending was pretty good, especially online. So I think the market's going higher. I think the bond yield at 5% found buyers, and it's finding buyers here at 4.4%. I think we're going to be kind of range bound in the bond market for a while. I don't think the Fed is going to be in any rush to lower interest rates. I think if there's a risk in the global economy right now, it's that China's calamity turns out to have global implications. But I think right now the implications are fairly positive. On the geopolitical side, the Ukraine-Russian war continues to grind on. I'm reading some articles now that suggest that Ukraine's losing it and that the West is losing its interest in supporting Ukraine. While that's a horrible geopolitical development, the economic consequences seem to be fairly muted. And while oil prices went up a lot early last year on the invasion of Ukraine by Russia, oil prices have been coming down, reflecting, I think, the weakness in China, the weakness in Europe. And again, we're beneficiaries of all that. The other horrible geopolitical development, of course, since October, has been the war between Hamas and Israel. There has been an exchange of hostages, and there's been a truce here. I kind of doubt that this is going to lead to a permanent truce or a permanent ceasefire. So that problem hasn't gone away. And meanwhile, the Iranians continue to, I don't know if they're instigating or actually guiding their subordinates in some of the other countries to continue to attack U.S. bases. So we have that going on still, from what I understand, in Iraq and Syria. So the Middle East still poses a threat, but maybe Taiwan less so, based on what we're seeing in Chinese economy and Xi's speech. Maybe less of a chance of a regional spread of the conflict in the Middle East, and just some sort of resolution, probably at some point through negotiations between Russia and Ukraine. At this point, it looks like it's going to be to the disadvantage of the Ukrainians. Well, that's a quick update on my views of things. Why don't we have a look at some of the charts that are relevant to what I covered in the morning briefing. The morning briefing basically devoted to the roaring 2020 scenario. Since 2020, I've been suggesting that there's two alternative paths for the U.S. economy in the decade ahead. And one would be the great inflation deja vu all over again, two peaks in inflation, lots of inflationary problems that persist, and inflation persists, if not through the end of the decade, through most of the decade, keeping interest rates high, creating problems for the economy, and so on. The alternative scenario is a much happier one, and that's a roaring 2020 scenario in which, like the 1920s, the 1920s started out horribly. A couple of years before, there was the end of World War II. Millions of people died. The pandemic occurred in 2018-19. Millions of people died. There was a bad depression, as they called it back then in the United States in 1920. And as bad as all that felt in the early 1920s, it turned out to be the roaring 20s, led by technological innovations that greatly improved productivity and the standard of living in the U.S. I know it ended badly, but that was the government screwing up with the Smoot-Hawley tariff. Controversial view still, I don't know why. But let's not talk about the past. Let's talk about the present and the future. And what I see is that we are in the early stages of a productivity growth boom that started actually in late 2015, got derailed, disrupted by the pandemic, and now it's resuming. And I think we're going to see some significant growth in productivity, which will be great for boosting economic growth, for allowing wages to rise faster than prices, for being positive for profit margins and profitability. Well, let's take a look at some of these charts that are related to this story. And again, I think things are working out reasonably well in that direction. I think there's less risk of great inflation like the 1970s all over again, and a greater likelihood that we are, in fact, going to see something much happier scenario. So here's high-tech capital spending. You can see that it's been going up in an exponential fashion. I don't know if that's much of a slowdown, but I mean, things never go up in a straight line, but that's pretty impressive. The high-tech revolution really started in the 1990s, particularly in the second half of the 90s with the PC revolution, the software revolution, Microsoft and Intel. Some of that got boosted by spending for the year 2000 problem. And we had this decline in capital spending for a while. Then we resumed the climb, and we've been on a tear ever since. If you look at high-tech's share of capital spending in nominal GDP, and you got to do it nominal because if you can't really compare real indexes to real indexes, there's some statistical issues with doing that. But in nominal terms, in terms of what people spend out of capital spending budgets, you can see that back in the 1960s, they were spending 15, 20%. And now they're spending 50%. And I think that's a underestimate because this includes information processing equipment, computers, and the like. It includes communications equipment. It includes software. It includes R&D. I think what it doesn't include is things like industrial equipment, even transportation equipment. Everything, all these capital goods have become more technology intensive. They've got more semiconductors in them. They got more software in them. And so I think we're seeing that at least 50% of capital spending budgets are being spent on technology. This is just another chart of a breakdown of these things. You can see that, remember, there wasn't too many years ago that I can recall that there's a lot of angst about American companies not spending enough on R&D. Well, according to the data, they're spending plenty on R&D, and they're getting a lot of bang per buck out of these research dollars. And but anyways, you can see software is another area where spending is very strong in current dollars. And some of this weakness in processing equipment may simply be that a lot of this stuff has gotten commoditized. It just doesn't cost as much as it did in the past. So there's a deflation in some of these technologies, particularly hardware. This is just another slice and dice looking at the percentage of each of these. You can look at it on your own. This is industrial production of technology, and you can see that we had this back here. We had this boom in computers. Everybody was getting a Dell computer at Deutsche Bank when I was there back then. They were getting Microsoft Office. All of that had to be installed by a few hundred IT people because you had to put the machines in people's office, and then you had to install the software. And then every time there was an upgrade, you had to go to the individual machines and do that. All that has changed with the cloud. And again, we had some strength going into great financial crisis in technology. But the real boom has been the current one, as you can see from this chart on industrial production of the various components of technology. So here's this productivity story that I've been telling for a while, and this takes a look at the 20% change at an annual rate in productivity. I do that because you can see the big cycles in productivity growth much better that way. So there was a productivity boom that you can kind of see the tail end of in the 50s. There was a productivity boom in the 60s. These are growth rates at an annual rate. And then you can see that one of the contributors to the great inflation of the 1970s was a productivity collapse from over 4%. And that's kind of on a 5-year basis looking backwards. So it's collapsed from that kind of growth rate down to virtually zero for all sorts of reasons that we've discussed in the past. A little Reagan boom in productivity, then it kind of faded. And then we had this productivity boom in the second half of the 90s that faded. I think that's because a lot of that strength in productivity was actually increasing the output of things like PCs and software. And a lot of that PC and software really was focused on things like Excel spreadsheets and word processing, which had really limited applications for businesses across the board. And so we saw that productivity boom fizzle pretty significantly until the end of 2015. We hit a low there. And then we started to go from 0.6 up to 1.6% growth in productivity. That's pretty substantial. Then the pandemic screwed it all up. And now I think we're back on track to go up to, by the second half of the decade, to 3.5 to 4.5%. Sounds far-fetched, maybe delusional, but it's happened before. And I would say that the arguments for a productivity boom being much more substantial and more credible is greater now than it's been in the past. We've got far more technologies that are far more adaptable to lots of businesses to increase efficiency, to increase productivity, to replace, well, not to replace workers, but to augment the productivity of workers because we get such a shortage of them. This shows you, by the way, productivity on a quarter-to-quarter basis and a year-over-year basis. Again, they tend to be volatile. You don't see the cycles as clearly as you do in this chart. But the past 2 quarters have been very strong productivity quarters. And so that's certainly encouraging. And the year-over-year is up to 2.2%, which is also encouraging. So the roaring 2020s, I think, is gaining some credibility here. This is another picture of what we just looked at. The red line this time is the productivity numbers we just looked at. But look at this blue line, which is the 20% change in real hourly compensation. This is the broadest measure of wages, salaries, and benefits. It tends to be very volatile on a quarter-to-quarter basis. But again, when you smooth it out the way we're doing it, you can see that there's a cycle, and that cycle is very coincident with what you see in productivity, which makes sense. The only thing that ever made sense to me when I studied economics was microeconomics, in which we learned that workers' real wages divided by prices, are tied to productivity. In a competitive marketplace, productivity is really what determines real wages. And this chart certainly confirms that idea. So if I'm right about productivity going up to 3.5, 4.5%, that's what real wages are going to do. And that's what's going to drive consumer spending, drive the economy, and drive a roaring 2020s kind of scenario. I know there have been some people pointing out that there's been a productivity gap that you can see here. This is the level of productivity, and this is the various measures of real hourly compensation. Instead of year-over-year comparisons or 20-quarter year-over-year comparisons, what we're doing here is looking at the levels, and you can see that if you take real hourly compensation divided by the CPI, which is what naysayers always do, they always take the data that supports their story, just the way bulls like me always take the data that support our story. But I try to be balanced by at least acknowledging what the other side is saying, more often not only acknowledging it, but trying to rip it apart. And I find this pretty easy to rip apart. the CPI is over time a very biased measure of inflation. If you take the consumption deflator, you see that the gap between productivity and real consumption narrows. And then in economics and macroeconomics, what we really learned is that it's not the consumer prices that are relevant here. It's the prices that companies get paid that determines the real wage and its relationship to productivity. And so when you look at the price deflator that businesses get as prices they receive, that gap narrows even further. But the bottom line, of course, is no matter which of these you take, if productivity is going up, real wages are going up. And the chart here was based on the non-farm business price deflator. I hope that's not more information than you need, but I think it's relevant. So here's an interesting chart. How about the idea that low unemployment is good? It's not inflationary. It doesn't have to be inflationary. The idea that growth is good, again, doesn't have to be inflationary if it's based on productivity. And this is not a perfect inverse correlation, but it's pretty compelling that when the labor market is tight, when the unemployment is low, there is a tendency for productivity, at least on a current basis and or lag basis, to pick up. To take the obvious points here, here's the unemployment rate bottoming and productivity getting moving higher. Here you see the unemployment rate going up and productivity taking a dive. Unemployment was quite high in this period, productivity was down. So when you're in a period of labor shortages, companies find that if they just simply raise their prices, they're going to have to raise their wages, and you just kind of spin your wheels in a wage price spiral. If instead you figure out ways to increase productivity, it's a win-win situation for everybody. Real wages can go up, productivity goes up, the economy grows better, and that's kind of what I'm seeing unfolding up ahead here. The inflation numbers are clearly very much impacted by productivity and hourly compensation. This shows you unit labor costs, which is simply hourly compensation in current dollars divided by productivity. And that on a year-over-year basis, without taking the cockamamie 20.25% change that I do, you can see that unit labor costs are very highly correlated with the CPI. CPI is highly correlated with unit labor costs, and it makes sense that unit labor costs are what's driving the CPI. And guess what? Unit labor cost inflation is down to 1.9%. So this is turning out to be a pretty spiky inflation experience. It's turning out to be more transitory than persistent, and that's been my view of late. How about this idea of the consumer? What are they going to do here? Well, this shows you the misery index, which is the unemployment rate and the inflation rate. And you can see the blue line, the misery has actually come down quite a bit, and yet consumer sentiment is quite depressed. I think there's a certain amount of money illusion. I mean, clearly when we go to the stores, when you go to the supermarkets, maybe prices aren't going up as much as they used to, but the prices are still much higher than they were. What people forget is that their wages have also been going up. And as you can see here, for all the talk about real wages being stagnating for decades, which is what progressives often say, if you look at, and this time I'm dividing by the consumption deflator. So you can see the real wages have actually been increasing since 1995. This is where they stagnated back here. So you see that the productivity gains have been boosting real wages on a fairly consistent basis. This is about a 1.4% trend line in real wages. And you can see they stagnated here during the pandemic. So it's true that prices went up a lot, but so did wages, but not more than prices. And so we had a stagnation there. And now we seem to be going back on that upward trend line. And if I'm right, it should be actually somewhat higher than the trend line for a while in a productivity boom scenario. Consumers should be a little bit more optimistic, and they certainly have more money in their pocket when you look at how much they're spending on gasoline. And you can stare at this chart on your own, but they're basically at an annual rate spending $1,000 less. So that's some pocket change to keep consumers spending. Finally, a final note. While I was talking about the misery index, I decided to compare it to the PE of the forward PE of the S&P 500, and you can see that they're inversely correlated. I'm not convinced that the PE has a simple relationship with inflation. The idea is higher inflation, lower PE, lower inflation, higher PE. I think that's part of the story, but I think the other part of the story is higher inflation, the greater the risk, and we actually fall into a recession. So it's recessions where you really see the PE taking a dive post. But there certainly wasn't an inflation problem here. It's just the high valuation multiples on some of the technology stocks got whacked because technology stocks underperformed for a while here. But it's a complicated story. We're writing about it. We'll write some more about it. Anyways, I apologize. It took up the bulk of the time here. I'll take a couple of questions. Don't bother putting any more in. I've got enough to cover here. Let's see. Yeah, Ian, thank you. Happy Thanksgiving to you. Ian, what are your thoughts on the relationship between bank restricting consumer debt, consumer revolving debt, and possible delayed headwind? Yeah, I mean, the headwinds are still there. I guess if we're going to have a recession after all, it would be because monetary policy has a long and variable impact on the economy. The consumers continue to spend pretty well. A lot of consumers really aren't getting hurt by higher interest rates. They're benefiting from high interest rates. So that's one thing to recognize. As I mentioned, there's now this statistic out that 40% of homeowners don't have a mortgage, and the others probably refinance, so they don't have an issue. I think what we're seeing on a weekly basis, which is what we're monitoring, is auto loans, and auto loans have turned negative on a year-over-year basis. And yet auto sales are holding up reasonably well. I guess there's still some pent-up demand for housing. But look, I don't think that the third quarter 4.9% real GDP is anything that's sustainable. I do look for something more like 2% up ahead here. But if it turns out to be worse, I'll have to acknowledge and raise the odds of a recession. We'll see how that plays out. I'm willing to acknowledge that things are changing. And I'll reflect that in my assessment of a recession probability. But the other possibility is that growth turns out to be better than expected, better than 2%. And why might that be happening? Well, the roaring 2020s, baby. That scenario plays out. That would be a really happy story. Okay, we got Chip here. The productivity story resonates. Thank you. Is there a rule of thumb for a correlation between a 1% increase in productivity and the growth rates in EPS and GDP? Well, the EPS I'm going to have to look into, but the GDP is a layup. Basically, the arithmetic of GDP, and it's just straightforward arithmetic, is GDP growth is equal to the growth rate in the labor force and the growth rate in productivity. It's all gravy. I mean, if we go from 1.7% productivity, which is what the latest number is for the 20-quarter annual average, and we suddenly are, instead of looking at 2%, we're looking at 4%. That's all goes straight into real GDP growth. But I'll have a closer look. It's a good question on the EPS. Michael, no question for you. Just wanted to say great presentation, that it offered lessons on how to read data, not just an interpretation of them. Okay, thank you very much, Michael. I'm glad you appreciated it. Okay, one last one. What's the next route for the U.S. debt and fiscal balance getting back to rational levels and do not hurt dollar sovereignty? Boy, you had to spoil it for us. There's still plenty of problems in the world. Don't want to get too happy here, though it is the holidays and we should be happy. Have a good attitude, and maybe the stock market will continue to give us this a continuation of the Santa Claus rally. But the debt crisis is something that people like Ray Dalio have been talking about. I don't know what it is about these billionaires being so pessimistic. Maybe they've already made their billions and want to cautious us about taking any risk and turning into billionaires ourselves. But Ray Dalio and even Stan Druckenmiller, very smart guys, but very pessimistic. Even Jeff Gundlach is talking about a recession next year. So there are things to worry about. And people ask me what happened to the bond vigilantes, and I guess what happened to them is they recognize that inflation's moderating, so that's a good thing. Janet Yellen happened. Don't fight the Fed, don't fight Janet Yellen, who's at the Treasury and smart enough to cut back on the notes and bonds. In early November, she announced that, and so that kind of calmed the bond market down. And then 4.5%, 5% bond yields relative to an inflation rate that looks like it's going down look pretty attractive. But the bond vigilantes are still going to be there, and they could rise up again, saddle up, and go on the hunt for the fiscal policymakers, because clearly we're in an unsustainable course for fiscal policy. Better than expected growth would help, but we do need to have less partisanship. Oh, there we go. Bailey just entered. Maybe my wife went out for an excursion. Let's see what else we got here. I think, Gus. Okay, I'll cover Gus here. Gus, Ed, regarding China's real estate, what are the red flags you're looking at for leakage into other economies? I think we're getting that leakage, but it's a positive leakage. We're getting lower inflation, I think, because as I wrote in the quick takes, the last quick takes that we put together last night, our import prices from China are declining, down 2.5%, and that's having an impact on goods inflation. So I think that's a positive. And another positive is possibly in the geopolitical realm, that it reduces the likelihood of them invading Taiwan anytime soon. Hope I didn't just jinx it. But I think we're seeing it in oil prices. Oil prices have come down. The price of copper has stayed down. They're just not buying a lot of copper because they're not building a lot of apartments. So I'll be watching those. So again, thank you all for joining us. Have a great week, and we'll see you again next week. Thank you.